Today we're going to react to a video Dave Ramsey posted a couple years ago where he answers a caller's question about the VA loan, and unfortunately he's just wrong about some of it. And I will say, I've said it before, Dave Ramsey's great from getting you from negative to zero, but once you get to zero, if you want to build wealth, Dave doesn't even build wealth the way he talks about. That being said, we're going to dig into the VA loan answer. Let's see what Dave has to say.
I'm getting ready to transition out of the military, and I'm looking at living options once I get out. I'm going to go to college on the GI Bill, and I've been really struggling with whether or not I should rent or try to buy a home, but it doesn't seem like there's any way that I can get pre-approved for a home loan.
Before he answers that, let me just touch on this. If you are a year or more before you exit the military, you can still qualify for the VA loan using your military income. Once you get within that year, it becomes a lot harder because they know your income is going to end, right? Because you're leaving the military. So it's going to be kind of dependent on like what job you, like if you have a job in the military and you have a job lined up with like a job offer letter and everything, and they're similar occupations, you can get by with kind of a smooth transition there on income. If not, you may have an issue where for a few years or for a year or two, like you have to work on showing that income trail to qualify again. Like being in the service is actually a huge benefit to being able to qualify for the loan because our income is uniquely set up to help us qualify for mortgages. Like it's just, I'll show you in a minute when I break stuff down. Veterans are above average consumers when it comes to loans in general, right? And so his question setup is, I don't know how I'm going to qualify. Now, the answer to that, one way, VA disability income counts towards a mortgage. In fact, it actually counts as about 25% over what you receive because they have to factor back in what that income would look like pre-tax because it's tax exempt. And then, unfortunately, your BAH with the GI Bill does not count towards that mortgage, but, a job that you have can. It just depends on, like, what kind of, like, if you move into a sales commission job, they're going to want to see 2 years of tax returns just to validate your income. But if you move into a similar career field that's salary, you can get it approved much faster. So it kind of depends. So his preface is good. He's coming from a good spot. And then he kind of changes the question from like, how do I get qualified, which is what his first preface is, to like, why don't you like the VA loan? And here we go.
You hate VA loans so much, and also what your best advice is to me.
Number one, the VA loans are more expensive with fees and interest rate.
Wrong. Flat wrong. Right? Couple things here to unpack. Yes, there is a funding fee. It is 2.15% of the mortgage on your first use, and then it goes up to 2.45 or whatever on your second use, or it depends after that. Couple things. First, if you're a Purple Heart recipient or 10% disability, waived. Like no funding fee at all. So nothing to worry about if you fit one of those two categories. Second, it's rolled into the mortgage, so you don't have to pay it up front. So it gets rolled in, and so what it does is it adds about, on a 7% interest rate, I did the math on this, it adds about $14.30 a month to your payment for every $100,000 you borrow. So on a $1 million loan, it adds about $143 to your monthly payment. On a $100,000 loan, $1,430. Now, that sounds bad up front, except if you go any other product and you do not put a full 20% down. So if you go conventional, FHA, physician, anything else, you're going to pay mortgage insurance premium right up front and PMI, which is just a monthly payment, private mortgage insurance that's required until you get 20% equity and ask the bank to remove it. Math wise, here's how that plays out. My first duplex, I used an FHA loan. I put 3.5% down. That property was $79,900. Now, mind you, this was like 9 years ago in rural Missouri, but 80 grand, call it. My monthly payment for PMI was $81. So it's about $100 a month for every $100,000 you borrow. So to add these in, VA loan, $143 if you borrow $1 million. PMI, around $1,000 a month if you borrow $1 million. Which one of those is better? Now the alternative here is that I'm sure he's going to suggest is like paying cash, but the math, like you can earn a return. If you have $1 million cash and you stick it in an index fund for 30 years, it's going to be way ahead of if you put it all down on a house and just let it ride. So just saying. Oh, and interest rates. That's just flat wrong. Twofold. One, if you buy a duplex, triplex, or fourplex with a VA loan, your interest rate is not going to change versus a single family house. But with FHA or conventional, immediately duplex, triplex, fourplex adds 0.5 to 0.75% to your interest rate. They all have a hike other than the VA loan. Secondary, loan products have what's called a loan level adjustment. This means that at different credit scores, your rate will go up. So if you have an 800 credit score, your rate will be the best you can get. If you have a 739, on most of these loans, they adjust the first time at 740, actually 780. So if you have a 779, your rate will be a little bit worse than 840 on a credit score, right? So if you have 800 credit score, your rate will be better than 750 credit score, which will be better than 720 credit score, which will be better than 650 credit score, which will be better than 600 credit score. Got it? The VA loan, so FHA and conventional, they adjust at 780, 740, or 740, 680, and 640, something like that. There's 3 adjustments by the time you get to 640 on your credit score. The VA loan doesn't have that. The first adjustment is at 640. So a VA applicant with a 645 credit score will get the same rate as somebody with an 800 credit score. So combine that with, if you buy a fourplex, you don't have the rate hike, you get better rates on both fronts. Historically, and you can go look up all the math, VA loans do have a better interest rate. And we haven't even talked about the VA IRRRL, which is a way to reduce your rate down the road. So all in all, false. Lower fees, lower interest rate. Beep.
Any of the big 3, FHA, VA, or conventional. Number 2, VA loans. The reason most people gravitate towards a VA loan is you can get a house with nothing down.
That is very appealing. And I am the first person that will say, if you can buy it 0 down and keep the cash in your bank account, you should. That being said, here's the data from 2023. According to the U.S. Department of Veteran Affairs, the VA themselves, the average VA loan borrower in fiscal year 23 had a loan amount of $360,862. So $361, call it. Now, additionally, typical VA loan borrowers have an average credit score of 721. Not like incredible, but not bad at all, right? That's a good credit score. A gross monthly income that exceeds $9,400 a month and nearly $60,000 in assets or net worth. So, now I acknowledge that $60,000, that could be equity, that could be a car you own free and clear, that could be your TSP. It might not be cash. But for the sake of argument, let's just say, if it was cash, that'd be 16.5% that you could put down on a loan, right? So you're not, this, like, I hate this argument that because it's 0 down, it's riskier. When right here it says that the average VA borrower has the money to put down on a house. Because 15%, 16%, 16.5% down would get you into an FHA or a conventional loan. No problem. It would almost get you out of PMI range. So your average borrower has enough cash to put down on a house. They just choose not to because they'd rather keep it in their pocket than put it down in the house. And I think that's less risky. And here's why. If you put 20% down on a house, let's say you had 20%. You had 20%, and you're buying a $100,000 house, you had $20,000. You put that $20,000 into the house, you now owe $80,000. So you lowered your payment a little bit, not much, but a little bit, and you've got $20,000 in equity. So the people think it's safer because if the house goes from $100,000 in value to $90,000, you're not underwater. You can still sell it without coming out of pocket. That's true. But if you just don't sell it, not an issue, right? That's the key to real estate. Just hold on long term. If you buy it and you put all $20,000 down, and 3 weeks later an HVAC goes out, where do you come up with the money? You can't pull it out of your equity. Bank only lends 70 to 80% on a HELOC, so they're not going to give you a line of credit on your equity. You can't pull that equity out of the house, so you can't spend it. You can't use it. You can't bail yourself out. All right, so you're screwed because you put all the money into the house and you don't have reserves. I would much rather say, and I will argue till I'm blue in the face, it is safer and wiser to keep that down payment in your bank account. Put 0 down, and now if something blows up in the house, you've got $20,000 to solve that problem or to make monthly payments with if you lose your job. It's reserves. It'll cover you. You lose your job, you can make a payment or two out of that while you get a job. Like, instead of having all of it in the house, and you can't make payments with equity. So that's the more secure way to do it, as long as you just ride out long term, right? So I will argue that. Also, I will say, if you put that $20,000 in an index fund and let it ride for the duration of the time that you own the house, the money saved on the mortgage is peanuts compared to the return and the growth that $20,000 will see over 30 years. So numerically and investing wise, the math adds up. Index fund for $20,000 beats equity 20% down payment, right? That being said, I also did the math here at a 7% interest rate, which is higher than what you would get right now. You're looking at a $2,900 to $3,000 payment, call it, for, and that's so well $2,850 without PMI and like $3,000 with PMI. It might be a little bit off. This is speculating. It says 2826 versus 2976 with or without PMI. That's including taxes and insurance. Now this is just a rough math because I didn't know. I just did I left the property tax at $2,700 a year and the PMI at 0.5%, which is the low end for PMI. And home insurance at $2,400 a year and no HOA. I just did basics, like I just left all the auto-populated numbers there. So you're looking at, call it $3,000 a month in mortgage. And if you make $9,400 a month, that's less than a third of your income. That's a great spot to be for a mortgage payment. That's very reasonable. You've still got $6,400 a month left over to live on, right? Or your other debts or whatever. So like that's a very low debt to income ratio. 30% is fine. Very safe, very secure, very like when we rent to tenants, we want to see between 2 and 3 times the monthly rent coming in as their income. This guy's over the 3%, over the 3x mark. I would lend to him. So good average borrower. So anyway, I digress.
And that's
which means you're too dead gum broke to buy a house.
No, it doesn't, because putting 0% down doesn't mean you have no money. It means you're taking advantage of the opportunity to let the government back your 20% instead of you, so you can have money in the bank account. I hate when sellers have this idea that because you want to use a zero down loan, you have no money. I have plenty of money, and I would go zero down.
A house with no money, a house is not a blessing.
Okay.
And so, because the air conditioner is going to go out next week.
Bingo. Exactly why you want the cash.
So I want you to have a house. I just don't want it to have you. So that's the reason. It causes people to buy a home when they're in a position of weakness rather than strength.
Okay, I'll agree. It does afford people a little bit more opportunity to get in over their head. But I'm not advocating for buying a stupid property out of your price zone, like that you can't afford at the top end of everything, maxing out everything you can possibly get away with, having no money in reserve and still going zero down. I'm advocating for using the loan in a way that you buy a normal house. In fact, I think house hacking is the way to go. Now, we could go way off on that tangent. Go look at some of my other comments or my other videos, but I'm talking about house hacking and saving some money in reserves to make yourself safe in case of things blowing up like air conditioning so that you're covered, and then beginning to build your wealth.
What I would tell you to do is rent the least expensive thing that you can, and let's work on your career and work on your goals and build up some money.
Again, not terrible advice. But what if you house hack with the VA loan, and now you're paying $0 out of pocket to own the place because you bought a fourplex, your 3 tenants are paying you to live there. So you live in it, we live in it for break even, absolutely free. You have no rent now, but you're building equity off of your tenants paying your mortgage down and the property going up in value. And you have some cash in reserve for if things go wrong. That's an even better situation.
In that case, that leaves me with one of 2 options. I can either live with my parents for $350 a month.
How long have you been in the military?
I've been in the military for nearly 5 years when I get out.
That'd be really painful.
At least he's right about that. You don't want to, quality of life matters.
My parents, I love them to death. Great people, but it's difficult to live with them. And so my next option would be renting an apartment for about $850 a month.
Yeah, try to get you a roommate situation where you can get that cut down, but you don't need to be back at home.
I agree. A roommate, cut your expenses. I get it. And I agree, you shouldn't go back home because quality of life matters, and being happier and healthier will lead to more financial success. But I don't agree that renting a space for $850 a month, or even for half of that, $425 a month, is better than going zero down on a home if you have good credit, cash reserves, and income that can sustain it. Or in this guy's case, he's going to be able to use his GI Bill to help pay for it. You can't use the GI Bill to qualify, but you can use the GI Bill to help pay those payments. And he could buy the place and still have roommates, and they pay him house hacking, and then he lives for free, right? While building equity, while learning about cash flow and appreciation and depreciation and principal pay down and all those other benefits.
And with that, though, I guess I have some extra money in the bank that I could use to...
Oh, look. The average borrower has some cash. He's not broke just because he's interested in zero down. Ooh.
And if I were you, I would take it a step further and I would get a job in construction. Anything you can do around where you want to be, meeting those people that are doing what you want to do, what you're in school for.
Yeah, I agree with that advice. Obviously, get around construction. I think the experience speaks more than the degree, and most people would agree with that. But where I'm lost on this is, again, you're paying rent to live somewhere that you plan on living long term. It sounds like this is where he wants to live long term. So use the VA loan, house hack, buy a fourplex or buy a big single family house and rent to roommates so that you live for free. And now instead of having that rent payment, your GI Bill goes to your pocket to save and invest in other things. And you're making a $0 monthly payment to own a home where you're getting equity and principal pay down. So anyway, look, I'll throw this out there. Dave and the Ramsey team, if you want to have a real world conversation where we just go raw data, numbers, and we go back and forth, and I actually I'm happy to talk with you guys about ins and outs of the VA loan and how it actually works, because it sounds unfortunately like some of the misconceptions have made it to your show, right? Like the fact that zero down means you have no money. The fact that there's higher interest rates, which is just bogus. The fact that there's more fees, which is bogus. It's just misconceptions, and they're misconceptions that are spread generally by realtors and lenders who have their license but don't fully understand the product because they didn't read the VA guidelines. And then when someone comes to them for advice, they kind of, rather than saying, I don't have the answer, go use that lender, they say, oh, well, you don't really want to use that product, go use one that I do understand. And it's just unfortunate because it is, hands down, and undeniably so, the best product for service members and vets. And it can't be touched if you know how to use it correctly, which is we are trying to bash all those stigmas. So Dave, if you want to come on my podcast, or I'll come on your podcast, and we can have a long go about how the VA loan actually works and good ways to utilize it where you can have the best of both worlds, because I agree on the risk tolerance front in a lot of ways. But I don't agree with telling people that the VA loan is not a good product, or or spreading the misconceptions about it. And I'd love to help debunk that. So I'm here. Love to be on the show. Love to have you on the show. Let's connect. If you guys got something out of this, share it, comment, subscribe, whatever. If you got questions, happy to answer. Have a great day.